welcome to the special edition of the Asian Tigers. I'm Sheeren Bhan. We're in the heart of Hong Kong's financial district at the Morgan Stanley office in conversation with Jonathan Garner. Jonathan, appreciate you joining us here on CNBC TV 18. We ought to be talking about Hong Kong, but let me start by asking you about India. People are now getting a bit concerned about the correction that we've seen in India, 10% off for the Nifty from its highs. Do you see this underperformance versus other emerging markets as an opportunity to enter India? Do you believe that the valuations give you comfort at this point in time?
Yes, we do. We've recently actually increased our overweight on India. It's actually now at the top of the list of countries that we cover, so number 1 out of 27 countries we cover, and partly it is because of that correction that's taken place. So valuations have moved back quite substantially. We're below 16 times forward PE, and more importantly for people like me that look across the emerging market space, all the valuation premium India had versus other emerging markets at the end of last year has unwound, so it's actually now as cheap as it was in November 2013.
So it's a good point to enter.
It is, as long as we're right that the economy is going to pick up and corporate earnings is going to pick up going forward. And we are well above consensus on earnings growth over the next 2 years.
But on corporate earnings, because the December quarter has been the weakest that we've actually seen in the last 20 quarters, and the estimate doesn't seem to suggest that the next quarter or this quarter is going to be any better. What's the sense that you're getting about the strength of the recovery as far as corporate earnings are concerned?
I think you have to look at why corporate earnings have been weak in India, and I think it has a lot to do with the fiscal adjustment, which was quite front-end loaded. So if you actually look at the deficit to GDP, it came in much narrower than people were forecasting, so 4.1%, and we're heading for sub 4% fiscal deficit to GDP. And so government current consumption spending and subsidies were reduced, which is a good thing to kind of rebalance the economy in India. But you did see a near-term impact on corporate earnings. But when you actually look now at things like corporate capex and auto sales, which are picking up, probably lead indicators of a better earnings environment, then we do take comfort in that.
Okay. What are the downside risks at this point in time? Because you were talking about some of the positives or the advantages that India enjoys, and especially as far as the deficits are concerned, which we have been able to tame quite considerably on the back of lower global crude prices. Crude prices now moving up. How concerned would you be on the macro impact of that on India?
So India still has sensitivity to oil and also to global food prices, but our base case view is that we're not going to get significant increases, certainly year on year, in either oil or food from last year, and that actually, therefore, India's current account position is going to remain approximately balanced, which is one of the best current account positions I've ever seen India in, and I've covered India for almost 20 years now. So it's certainly true that you have seen somewhat of a backup in bond yields in India recently, and that may also have played a role in the equity market weakness. But we suspect that that's an opportunity again in the bond market. So there's been somewhat of a sort of a counter-trend move in relation to bond yields, reflecting that increase in the oil price.
But, you know, coming back to the equity markets, and we talked about the 10% correction, what do you attribute this? Is this just profit being taken off the table? Is it people rebalancing their portfolios, putting liquidity into other markets that are looking better at this point in time? What do you attribute this to, and how concerned are foreign investors about this entire imbroglio related to the FII MAT taxation?
So India, as I said, has recently replaced China as our top pick market in global emerging markets, and China has outperformed India very substantially year to date. And I think one of the reasons that we were not maximum overweight India before was positioning. So if you actually look at foreign institutional investors' holdings in India, they built up very substantially both before and after last year's election. So by the end of last year, the average global emerging market fund was essentially double weighted on India. Now that meant that for further performance in the market, you needed either the domestic retail investor or truly global money that's not EM or Asia ex-Japan benchmark to be attracted towards India. And neither of those two things have happened yet. But I would say in relation to domestic retail investor interest in India, if those bond yields can move lower and the macro turns, then it's very likely that domestic retail investor interest will grow in India. We've seen that actually in China recently.
You know, it's been about a year since the Modi government took office, and there was a lot of expectations on what this government would actually be able to do to deliver on the reforms agenda. Perhaps expectations ran ahead of fundamentals, expectations ran ahead of reality. At this point in time, would it be fair to say that the mood has changed significantly on the reform front? Because you know, you talk to some people and they believe that euphoria has now turned to despair. You talk to others, they believe euphoria has turned to realism. Which camp do you belong to? I would imagine the realistic camp.
Well, let's try and be precise about the kind of reforms that our foreign institutional clients really want to see from India. So I think the GST is really important, and there it looks that we are actually getting progress. It's passed the lower house, it should pass the upper house. The other really big one is land acquisition, which is much less certain in terms of actually passing in terms of the reform agenda. And then, in addition, I think foreign institutional investors want to see that budget deficit structurally lower, and that must mean addressing issues like the size of the Indian civil service. Again, if you look back at other really, truly reformist governments where you're inheriting similar problems to those that India actually faces structurally, addressing the functioning of the civil service in India is extremely important.
But do you get any sense that we've moved the barometer at all on that parameter?
I think Mr. Modi's done some great work from the top in terms of actually pushing the buttons and actually getting things like the road building program working. And we can see that in some of the capex numbers that I mentioned earlier.
But it's largely government spending, isn't it, on infrastructure?
Right, but what you still have to do is to deal with the actual government current consumption spending and the size of the civil service and civil service pay, and that's extremely important. It's the kind of things that Ronald Reagan or Mrs. Thatcher dealt with when they inherited similar problems in the 1980s in the UK or US.
On the infrastructure side, and you know, the government has allocated a substantial amount of spending, both as far as the road sector is concerned, the railway sector is concerned. Private spending on infrastructure hasn't kicked in just yet, and that is because we're suffering from broken balance sheets, so to speak, within the private sector. Do you really see private capex picking up anytime soon, specifically as far as the infrastructure side of the story is concerned? And how confident do you feel about the turnaround for the infrastructure story?
I think what you need there is stability, particularly around the taxation system, which is really crucial. If you're going to invest in a long-run project, you're going to try and make returns over many years, which is how these infrastructure projects work. You've got to have some certainty about the rules of the game that you're operating in, particularly the taxation system. And again, I think that needs more clarification going forward.
But on the taxation system, and specifically the issue with regards to the levy of MAT on FIIs and FPIs, how much of a concern is this? Because the kind of outflows that we've seen, especially between the 15th of April to about now, which is almost about $2 billion of FII money being pulled out of the market, a lot of people believe that this is linked directly to the confusion over the MAT levy.
Yes, so retrospective taxation is never a good idea for any country, and you need ideally a very simple corporate and income tax system that is fairly administered and is consistently administered through time, and that remains a challenge for India.
But this doesn't worry you, clearly.
Well, it's one of a number of things that we look at. As I mentioned, we were actually slightly overweight India by the end of last year and into early this year. We've now increased it very substantially because, on our view, this near-term pickup in economic growth is just about the best story that we see in our general coverage universe. One of the things that concerns us about China is we've had a very good run in the market, but actually economic growth is still losing momentum. In Indonesia, it's losing momentum quite significantly in the same areas, actually, things like automobiles and capex, where we can see early signs of a pickup in India. So, yes, India has a number of challenges that still remain, structural challenges, but the near-term growth number that we're forecasting for this year is 7.7%, and that's an acceleration from last year, and it's actually a better performance than other markets we could.
A better performance than China as well, in fact, significantly better over China. I know you won't talk stock-specific, but in terms of sectors that excite you about India, given the current valuations, what are you looking at?
So we like some of these cyclicals, both industrial cyclicals and consumer cyclicals, and we also like the private sector financials, and that should be the core of the portfolio. There are other areas, obviously, historically, pharmaceuticals and software names, and some quality stocks in consumer staples that have generated very high returns. And those were actually the names that we liked when we were much more concerned about India before Mr. Modi was elected. But right now, we think it's right to take more cyclicality, add more cyclicality to the portfolio.
Just specifically as far as the pharmaceutical and the software sector is concerned, and the linkage to the rupee, because we've seen the rupee now at a 20-month low. What's the outlook as far as the currency is concerned, and the impact on sectors like pharma, IT, for instance?
We think going forward it's going to be broadly stable in, let's say, a 62 to 64 range. We're actually at the higher end of that range right now, probably linked to the move up in oil that you mentioned earlier and the slight move higher in bond yields. So maybe coming back down towards the 62 level. And that's, again, a better outlook than we see, particularly for other countries' currencies in Southern Asia. So we would see currencies like the Indonesian rupiah, the Thai baht and the Malaysian ringgit, all actually weaker than the Indian rupee going forward.
As far as the consumer story is concerned, and there are concerns on consumption, specifically rural consumption, given the fact that agricultural growth has been severely impacted because of the unseasonal rainfall, and now the possibility of another year of a subpar monsoon. Yes. How worried would you be about that?
Yes, we certainly always watch that in India. It is very important, given the size of the agriculture sector in the economy. And it may pose a threat to our inflation forecast. We're actually forecasting CPI below 5% in India for this year. And it might limit the ability of the RBI to cut interest rates going forward. And we just have to monitor it. But in our base case, we are actually able to get at least another 150 basis points off interest rates as inflation falls.
You preempted my question because I was going to ask you about that. I said, you know, China has already seen another 25 basis point being cut, and that's the third since November. Do you see that there is room for at least another 50 basis points as far as this calendar year is concerned, or at least this financial year? Because the jury is out on how much the Reserve Bank will have room to cut rates.
We would see, I think the next meeting's coming up on 4th of June, unless I'm mistaken, and I think we should see further interest rate reduction.
So another 25 basis points in June?
25 or maybe 50. It does depend on all of these things that we've already been talking about. So the perspective of the RBI about global growth, about the trend in commodity prices and domestic inflationary pressure. But I do think that this fiscal adjustment is probably the most important, and that fiscal policy, any central bank is often looking at the fiscal authorities and saying, are we working in partnership? And I think there probably is a good partnership there. So again, we would expect interest rates to be coming down further in India.
And linked to that is the question on what the Fed will do and how soon will the Fed act. Do you anticipate a Fed liftoff before December? We've got a strong jobs data report out, unemployment numbers now down to a 7-year low at 5.4%. What do you anticipate in terms of Fed action? How soon?
So for us, it's December is our call, and we would expect the Fed to start very slowly, 25 basis points every other meeting, and actually only get to about 1 5/8% over a sort of an 18-month horizon, and that's somewhat tentative. So we do not see a very aggressive Fed here, because for all that unemployment rates have fallen in the US, growth is still relatively weak, and there is an absence of wage inflation which would warrant, if it were to happen, a more aggressive response. So we think that they'll be going very slowly. And again, even a modest increase in interest rates in the US is going to be a challenge for countries like Brazil or South Africa or Turkey or Indonesia that still have large current account deficits. But we don't put India into that group anymore because of the adjustment that has taken place.
Yeah, so we're not as vulnerable as, or not vulnerable at all now as far as the current account deficit is concerned. But in terms of emerging market outflows, as and when the Fed were to act, if it is December, India, you believe, is a lot more secure than in the past. But what could we see in terms of rebalancing as far as emerging market flows are concerned?
If you look back to the summer of 2013, when we had the taper tantrum and India was very adversely impacted, other than the current account adjustment, what's changed is that you have no longer got very strong fixed income inflows into emerging markets. They haven't really been that firm since the summer of 2013. So we haven't got a lot of hot money portfolio flows in emerging markets. And that actually also applies to equities as well. The very strong gains that we've had in emerging equities this year in countries like China or, for example, in Korea or Taiwan, they've actually been more to do with local investor rotation into equities than the foreign investor, who's going to be more sensitive to the Federal Reserve.
So you believe that we are significantly cushioned from the possibility of any orderly or disorderly, or perhaps not disorderly, but orderly Fed hike?
I would say it's not going to be as much of a shock as we saw in the summer of 2013, but there still will be some effect, yes.
Before I talk to you about China, how much more downside do you expect in this current bout of correction? Down almost 10% now for the Nifty. Do you believe that we could have found a bottom here, or do you expect India to drift lower before we start to pull back once again?
So we upgraded India to number 1 in our ranking, so 250 basis points over benchmark weight last Thursday, and we suspect that we've seen the trough for now in the Indian market. We think it's going to go higher.